Monetary Policy Committee (MPC) and its role in rate adjustments. Understanding the MPC's impact on interest rates. Agenda items: Introduction to Monetary Policy Committee (MPC). Understanding interest rates. Rate cuts, purpose and effects. Rate increases, purpose and effects. Trends and outcomes. Formulation and structure of the MPC. Composition of the MPC. The MPC is formed by a group of appointed experts, including economists and financial analysts, contributing their expertise. Diverse perspectives. The structure of the MPC ensures a diverse set of perspectives and decision making, enhancing the effectiveness of monetary policy. Importance of effective policy. Effective monetary policy relies on comprehensive discussions and analysis from various experts to achieve desired economic outcomes. Objectives and responsibilities. Price stability. The MPC aims to maintain price stability to create a predictable economic environment conducive for growth. Interest rate management. One of the MPC's key responsibilities is to set interest rates to influence economic activity and control inflation. Monitoring economic indicators. The NPC must monitor various economic indicators to make informed decisions regarding monetary policy. Decision making process. Reviewing economic data. The first step involves analyzing relevant economic data to understand the current financial landscape. Discussing policy actions. MPC members engage in discussions about potential policy actions to address current economic conditions. Voting on rate adjustments. The process culminates in a voting session where members decide on necessary rate adjustments based on discussions. Definition and types of interest rates. Understanding interest rates. Interest rates indicate the cost of borrowing or the return on savings essential for financial planning. Types of interest rates. Interest rates can be classified into nominal, real, fixed, and variable rates, each for specific uses. Economic contexts. Different types of interest rates serve various economic contexts, influencing both borrowers and savers. Factors influencing interest rates. Inflation rates. Inflation significantly impacts interest rates, with higher inflation typically leading to increased rates as lenders seek to maintain purchasing power. Economic growth. Economic growth influences interest rates. A booming economy often leads to higher rates due to increased demand for capital. Central bank policies. Central banks set benchmark interest rates to control monetary policy, which directly affects overall interest rates in the economy. Impact of interest rates on the economy. Consumer spending. Interest rates influence consumer spending habits, where lower rates encourage borrowing and spending, boosting the economy. Investment decisions. Investors consider interest rates when making decisions. Lower rates typically lead to more investments in businesses and infrastructure. Inflation control. Higher interest rates are often used to control inflation by reducing spending and cooling down the economy. Reasons for implementing rate cuts. Encouraging borrowing. Rate cuts make borrowing cheaper, encouraging individuals and businesses to take loans for investments and purchases. Stimulating economic growth. Lower interest rates aim to stimulate economic growth by increasing consumer and business spending in the economy. Short term economic impacts. Increased investment. Rate cuts can stimulate increased investment in businesses, leading to economic growth and job creation in the short term. Consumer spending rise. Lower interest rates encourage consumer spending, boosting demand for goods and services in the economy. Inflation concerns. As economic activity increases, there may be concerns regarding rising inflation, impacting purchasing power and economic stability. Long term consequences. Immediate relief from rate cuts. Rate cuts can stimulate economic activity quickly, providing immediate relief to borrowers and consumers. Concerns about asset bubbles. In the long term, rate cuts may contribute to the formation of asset bubbles, increasing market volatility. Rising debt levels. Increased debt levels from sustained low rates can lead to financial instability and future economic challenges. Need for monitoring. Sustainable economic growth requires careful monitoring of the long term effects of rate cuts on the economy. Reasons for implementing rate increases. Combating inflation. Rate increases help to combat inflation by reducing consumer spending and borrowing, thus stabilizing prices. Cooling down economy. Increasing rates is a strategy to cool down an overheating economy, preventing unsustainable growth. Price stability management. By raising rates, the Monetary Policy Committee aims to manage price stability effectively, ensuring a healthy economy. Short term economic impacts. Impact on borrowing. Higher interest rates can reduce borrowing, leading to decreased consumer spending and investment, affecting economic growth. Slower economic growth. With reduced spending, the economy may experience slower growth in the short term, impacting various sectors. Price stabilization. Increased rates can help stabilize prices, preventing inflation and maintaining economic balance during fluctuations. Restoring confidence. Higher interest rates may restore confidence in the economy, encouraging responsible financial practices among consumers and investors. Long term consequences. Impact of rate increases. Sustained rate increases can hinder business expansion and lead to higher unemployment in the long run. Balancing inflation control. It's crucial to balance the need for controlling inflation while fostering economic growth to avoid negative consequences. Consequences of high unemployment. Higher unemployment rates can have detrimental effects on the economy, leading to decreased consumer spending and overall economic health. Trends in rate cuts, economic activity impact. Historical rate cuts often stimulate economic activity by making borrowing cheaper for consumers and businesses, leading to increased spending. Employment effects. Lower interest rates can boost employment levels as businesses invest more, potentially leading to job creation. Inflation considerations. Rate cuts can lead to inflation if economic demand outpaces supply, illustrating the delicate balance policymakers must maintain. Rate increases and their outcomes, controlling inflation. Historical rate increases have played a crucial role in controlling inflation by influencing borrowing costs and spending patterns. Impact on economic growth. Rate increases can slow down economic growth by making borrowing more expensive, affecting investments and expenditures. Effects on employment. Higher interest rates can lead to reduced employment opportunities as businesses may cut back on expansion and hiring. Consumer behavior changes. Rate increases influence consumer behavior, leading to reduced spending and changes in saving habits among households. Implications of rate cuts. Central bank rate adjustments. Recent adjustments in interest rates by central banks are crucial for managing economic growth and inflation, influencing global markets. Global economic stability. These rate changes significantly impact global economic stability, affecting investment decisions and market confidence. Lessons learned. Analyzing past rate adjustments helps us understand their long term implications and prepares us for future economic shifts. Conclusion. Role of Monetary Policy Committee. The Monetary Policy Committee is essential in influencing economic conditions through strategic interest rates decisions. Impact of interest rate adjustments. Interest rate adjustments can significantly affect inflation, employment, and overall economic growth, making understanding these changes key. Navigating economic conditions. Understanding the functions of the Monetary Policy Committee helps individuals and businesses navigate the economic landscape effectively. Thank you.